Hello everyone, welcome to part 2 of lecture 9. So in this video, we're going to talk about the mark-to-market due to daily settlement. So daily settlement means the futures exchange will adjust the margin account based on the fluctuations in the asset price, and the adjustment is purely between the long position holder and the short position holder, so that there's no risk in the to the operator in the market as the futures exchange. So let's look at how this works exactly. So if, say, we are a long position holder of the futures contract, that means that, for example, we will be able to buy an asset at a specified price, which could be 100 3 months later, right? Now we are going bullish in the position. So when the market goes up, for example, in 1 month later, when the market goes up to $120 for the assets, which means that we will be able to buy something that's actually more expensive than the specified price, then it's a gain for us. So we make profits due to the daily settlement, because the exchange will adjust the price of the futures contracts accordingly. So the profit comes from the short position holder, right? Who will suffer a loss from daily settlement. So there's a movement of money from the margin accounts of the short position holder, right, or the seller, to the margin accounts of the long position holder or the buyer, right? So that's what happens when the market goes up. Of course, during this process, if the margin amount falls below the thresholds required by the maintenance margin, then the seller or the short position holder will receive a call, which is called the margin call, from the futures exchange to top up the margin account. Now, on the other hand, if the assets drops in price, say $70 now, then we're actually buying something that is cheaper for a higher price, right? So that means that we will suffer a loss due to the daily settlement, and the loss will be debited from the margin accounts of the buyer and will shift to the margin accounts of the seller. So this is a profit for the short position holder of the futures contract. All right, so let's look at a concrete example. Now, in this graph, we have the x-axis denoting the time for each day, and day zero means that's the day when the long position holder and short position holder enter the position, right? So one goes bullish, one goes bearish. This 100 means that this is the amount of the initial margin, right? So everyone who enters a position needs to deposit 100 to their respective margin accounts. So this is the amount in the margin accounts, which also called the initial margin. So what happens is that on day one, the assets increases in price. So that's realizes as a profit for the long position holder of $5 due to daily settlement. So where does this $5 come in? It comes in from the seller's margin account. So we will deduct $5 from the seller's margin accounts and move it to the buyer's margin account. So that's the money movement on day one. However, on day two, the asset price drops by $20. So there's a $20 movement from the buyer to the seller. So we go down from 105 to 85, and then the seller's margin account goes up from 95 to 115. However, this movement will put the margin amount to 85, which is below the 90 threshold. So 90 is the maintenance margin specified by the futures exchange. So on day 2, what happens is that the long position holder or the buyer would receive a margin call from the futures exchange because it falls below the maintenance margin threshold. And the action will be that the long position holder will need to top up the margin amount by $5, right? By $5 to back to 90 so that it satisfies the minimum threshold requirements, and then continue. So this is what happens on day 2, which is the top up, the actual top up action, and so we would continue the daily settlements for the future days. All right, so that's the illustration of mark-to-markets, and thanks for watching.